Welcome to Frost Sullivan's Growth Podcast. This series brings together key insights from our research, growth analyses, and thought leadership, highlighting the strategic imperatives shaping industries, technologies, and markets worldwide. In this episode, we focus on the strategic imperatives shaping the future of the oil and gas industry, distilling essential perspectives to help teams understand what is changing, why it matters, and how organizations can align strategy with emerging growth priorities. For decades, growth in the oil and gas industry was largely defined by expanding production, securing resource access, and increasing operational scale. What's changing today?
Those fundamentals still matter, but they no longer tell the whole story. Companies now have to navigate decarbonization, geopolitical uncertainty, technology advancements, and evolving regulations all at the same time. These aren't short-term disruptions anymore. They're reshaping investment decisions, operating models, and portfolio priorities. Growth is becoming less about producing more hydrocarbons and more about building a business that's resilient to changing demand, policy shifts, and capital expectations. One of the biggest implications is that companies have to rethink where future growth will come from, starting with their portfolios.
Transportation fuels have historically driven investment decisions across the industry. As mobility continues to evolve, how should companies respond?
Demand for transportation fuels isn't disappearing overnight, but long-term growth is slowing as electrification and changing mobility patterns gain momentum. That means companies need to reassess how capital is allocated. Rather than focusing solely on traditional fuel assets, they're increasingly looking toward businesses with stronger structural growth potential, including LNG, integrated power, renewable energy, and customer-focused energy services. Equally important is adopting investment metrics that emphasize future value creation, capital flexibility, and resilience instead of relying primarily on historical production performance.
Automation and remote operations are advancing rapidly across offshore facilities. Is technology itself the biggest challenge?
Technology has matured considerably. The bigger challenge now is governance. Many operating models were designed around continuous on-site personnel. As facilities become increasingly automated, companies need governance frameworks that clearly define decision rights, safety accountability, escalation procedures, cybersecurity, and regulatory compliance. The goal isn't simply operating assets remotely. It's ensuring that remote operations remain safe, consistent, and accountable across the enterprise.
As companies expand into digital and lower carbon businesses, how do workforce strategy and operational execution need to evolve?
They're closely connected. Organizations need to redeploy experienced talent into emerging businesses without weakening the performance of existing operations. That requires structured workforce mobility, early planning, and preserving critical technical expertise. At the same time, companies also need faster operational decisions. Fragmented workflows between geology, drilling, operations, and commercial teams often delay project execution and increase costs. Using AI and real-time operational data can help shorten subsurface evaluation and drilling decision cycles, but only if digital tools simplify decision-making rather than adding new approval layers.
Carbon management has often been viewed as a reporting or compliance exercise. Why is that perspective changing?
Carbon costs are becoming part of core project economics. As carbon pricing, emissions regulations, and investor expectations continue to evolve, projects that appear attractive today may face weaker long-term returns if carbon exposure isn't considered early. Leading companies are applying internal carbon pricing, strengthening project screening, and evaluating how investments perform under tighter emissions policies before committing capital. Treating carbon as a strategic investment parameter, not simply a sustainability metric, helps organizations improve capital discipline while preparing for future market conditions.
Throughout this conversation, we've explored how the oil and gas industry's growth model is evolving. It begins with rethinking portfolio priorities as energy demand changes. It extends to modernizing offshore governance, preparing the workforce for business transition, accelerating operational decision-making, and embedding carbon economics into every major investment decision. Taken together, these priorities reflect a broader shift from pursuing growth through scale alone to building organizations that are more agile, resilient, and prepared for long-term industry transformation. That's all for this episode of Frost and Sullivan's Growth Podcast. For deeper analysis, research insights, and strategic frameworks shaping future growth, explore our studies and resources at frost.com or reach out to our team at hello@frost.com. We'll be back soon with more perspectives to help you stay clear-headed and growth ready.